Hey everyone, welcome back to Corporate Decoder. Today, LOKVU.U.S just filed an 8K report concerning a forward purchase agreement. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing reveals a significant deal designed to manage redemptions ahead of a business combination. And I think it tells us something important about investor confidence. Live Oak Acquisition Corp V, or LOKVU. As you probably know, it has just announced a pretty interesting agreement called a forward purchase agreement. Think of it like a pre-deal where one party agrees to buy shares at a certain price later on, and it is all happening in connection with their planned merger with Teamshares Incorporated. This is a big step in their path to becoming a publicly traded combined company. So what exactly is this forward purchase agreement about? Essentially, LOKVU.U.S is making a deal with HB Strategies LLC, who they call the FPA investor. This investor is agreeing to buy shares from LOKVU.U.S in a prepaid share forward transaction. The main goal here is to help manage how many regular shareholders will want to cash out their shares, also known as redemptions, when the merger with Teamshares is finalized. The agreement has a few key dates and terms. It is set to take effect on the day after LOKVU.U.S holds its shareholder meeting to vote on the merger. When the business combination, or BC closing as they call it, actually happens, LOKVU.U.S will pay the FPA investor an amount based on a set number of shares, up to a maximum of 4 million shares. This payment comes from the money LOKVU.U.S had set aside in a trust account from its initial public offering. This is all happening before the final merger is completed. The price they'll pay for these shares, the initial price, will be figured out a few days before the merger closes. It is subject to adjustments if things like stock splits happen. LOKVU, or the combined company, will also pay back some expenses to the FPA investor. Now, let's talk about the shares involved, called subject shares. These are shares that the FPA investor might already own or might buy from regular shareholders before the merger closes. Importantly, the FPA investor is agreeing to buy these shares at a price that is lower than what a regular shareholder would get if they decided to redeem their shares. This is a crucial detail because it means the FPA investor is stepping in to absorb some of the potential redemptions. They also agreed to give up their right to redeem these specific shares. The FPA investor is not obligated to buy any shares, and any shares they buy before the redemption deadline for regular shareholders must be at a price less than the redemption price. The number of subject shares can also go down during the term of the agreement if the FPA investor decides to terminate the transaction for some of those shares. The agreement has a term that lasts until 2 years after the merger closes, unless the FPA investor decides to end it sooner. If the FPA investor decides to terminate the transaction for certain shares, they will pay back a portion of the initial payment based on a calculated reset price. This reset price can be adjusted downward, and it will automatically change if the combined company issues new shares at a lower effective price. The forward purchase transaction can also be terminated if there are major negative changes affecting the combined company's business, or if other specific termination events occur. There are also provisions for extraordinary events like legal or regulatory changes, or issues with the company's stock being listed on an exchange. A really important point here is that the FPA investor is specifically waiving any claims to the money held in the trust account, except for those related to their rights as a regular shareholder, or for this specific prepayment amount. This is to prevent them from trying to pull money out of the trust account like other shareholders might. The whole point of this forward purchase transaction is to reduce the number of shares that might be redeemed by shareholders when the merger with Teamshares goes through. This can be a really big deal for SPACs like LOKVU.U.S because high redemptions can leave the company with less cash to fund its operations after the merger. The filing mentions that if the trust account were to be liquidated just before this agreement was signed, around May 29, 2026, the redemption price per share would have been approximately $10.54. This gives us a benchmark for what regular shareholders might have gotten. The structure of this agreement is also designed to comply with regulations related to tender offers, which is important for making sure everything is on the up and up. The full details of this forward purchase agreement are available as an exhibit, and it is quite a detailed document. So, to reiterate, the FPA investor is agreeing to waive their redemption rights for these subject shares. This waiver could significantly reduce the number of LOKVU.U.S Class A ordinary shares that get redeemed when the merger with Teamshares is finalized. This filing also points us to other important documents like the registration statement on Form S-4 that LOKVU.U.S and Teamshares filed with the CC. This statement contains a lot of information for shareholders who will be voting on the merger. The company is encouraging shareholders to read this information carefully. We're reminded that shareholders can get copies of all these filings for free from the Sexy's website or by contacting Live Oak Acquisition Corp V directly. The filing also talks about who might be considered participants in encouraging shareholders to vote for the merger. This is standard language in these types of filings and includes information about the directors and officers of Live Oak. And like most SEC filings, this one includes a section on forward-looking statements. These are essentially statements about what the company hopes or expects to happen in the future. They come with a big disclaimer, reminding everyone that actual results can and often do differ from these expectations. We're warned not to rely too heavily on these predictions, because there are many risks and uncertainties that could affect the outcome. Some of these risks include the possibility that the merger agreement itself could be terminated, that legal issues might pop up, or that they might not be able to get shareholder approval or keep their stock listed on an exchange after the merger. There is also the risk that the benefits they expect from the merger might not materialize, or that they might not be able to raise additional funding if needed. You can see a full list of these potential challenges in the documents filed with the SEC. Finally, the report clearly states that this document is just for informational purposes and is not an offer to sell or buy any securities. Any sale of securities must be done through a proper prospectus. And the filing wraps up by listing the exhibits, including the forward purchase agreement itself as Exhibit 10.1. The report is signed by Richard Hendricks, the Chief Executive Officer of Live Oak Acquisition Corp. V dated the 1st of June 2026. In my view, this forward purchase agreement is a really smart move by Live Oak Acquisition Corp. V. It is a way to proactively manage potential redemptions by bringing in a large investor who is willing to buy shares at a discount. This helps ensure that the merger with Teamshares has enough capital to execute its business plan post-completion. The fact that they're using this type of agreement suggests a degree of caution or perhaps an anticipation of significant redemption requests. It is a way to de-risk the transaction for both sides. By securing this FPA investor, they are essentially creating a floor for their available cash after the merger. The real story here is how SPACs are using increasingly complex financial instruments to navigate the often tricky post-merger landscape, especially when it comes to shareholder redemptions. For investors watching this deal unfold, it is a signal that the management team is actively trying to create a stable financial foundation for the combined company. The risk I am watching is whether Teamshares can actually deliver on its growth promises to justify the valuation and make this deal a success for all parties involved, even after accounting for this forward purchase. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like this video and subscribe for more. Check out the Discord linked below.